go. And if this board sets up as the week continues, and that is that yields certainly creep higher, then there could be the board might be a little heavy as the week goes out, and even worse than that possibly.
Well, all right, let's go to the minutes. I read the minutes. I just read them again. They're not, this is interesting to me. They're not as dovish, and that's what the market's reacting to, as the Powell press conference was. But here's what I know about how the minutes are crafted. The minutes are actually put together by the Fed chair and the secretary, the FOMC secretary. I'm not sure who that is now. I used to know because, it changes all the time. But right before the release, the Fed chair can do with them as they want. Now, Powell's press conference was extraordinarily dovish. And these minutes, they certainly lean heavily dovish, but not as dovish as the Powell press conference. So after my second reading, I said, I'm wondering whether with the sell-off in the dollar and the recent rally in the gold, whether Powell backed himself off or not in the way that these minutes were crafted. Because they're not, I think what's caught the market and what pushed the gold down and the dollar up, the interest rates really, the bond futures broke hard, but then they're not really, I'm looking at we're down 17 ticks on the 30 year, and the 10 year is down 3.5 ticks. It's not crazy movement. It's off their highs. They're not insubstantial, but they're not.
Question on that. Glad you came in.
Well, let me say, what I'm telling you about how the minutes are crafted is not conspiratorial, by the way.
No.
It's been done by every Fed chair. That's how I learned about it from people who actually partook in the process and explained it to me, that until the release of the minutes, the Fed chair can do whatever they want with it. So he wants to send a different message. And I think that's what the markets had reacted. So I'm going to give it a little time to breathe here.
I guess the question, and I think I'm glad you came in, because I'm not at all suggesting it would be, I know that you had stated only as you know from evidence. So if that is the case and the market continues, and even if the fact that the bond market doesn't fall hard, but even if it trickles lower, relative to where the pricing is going into this on some of this stuff, it could be still dangerous for the board, because we came in pretty hot, particularly on the tech side.
Yeah, and I'm not going to speak to the equities, because the equities have done what they've done, and actually the DAX held up even in the face of the late sell-off. They're a little bit off their highs, of course, but I think it was the market looking for more. Were they looking for evidently they were looking for a definitive statement about yield curve control, and the wording of that, and Peter Bookvar wrote a few paragraphs about it after the release of the minutes, saying, it was not, it's almost like they don't want to go there. And yet from all the comments from the end of the last Fed meeting in July to this week, I've been preparing that they'd be gearing up for yield curve control, which is what the market, which I've maintained, would drive the dollar even lower, and the precious metals higher. The minutes were a little more tepid on that, and it's like they have other tools to use, and that they were uncertain about it. So that's what has gotten to us. It may have been responsible for breaking the equity markets late too, as they read that, but they say they still have other tools. So the forward guidance, I don't know what they're going to pull out, and they're going to be a little patient here, because not that they're waiting for a vaccine, they just want to see if there's some stability. But I'll tell you what, from everybody I hear who's downtown, not me, but others, and people who see things, nothing's open. So I don't know where you think those jobs are going to come back from. And I don't know where the Fed thinks they're going to come back from. And now the universities have, what did they expect? That 20-year-olds weren't going to be 20-year-olds? Of course they're going to be 20-year-olds. And it's not like this happened suddenly. They have been pent up and corralled for 5 months already. So when they're given that freedom, do they get more intelligent? Hardly. Um, no,
Well, they're
listen.
just being young. We were that way.
Exactly. I would have been 20 years old, 21 years old with 107 14s, in the mail and having a party on my way back. Seriously, do you think I would have been worried about a mask? Hell no. That's what we can't, I've been amazed at how well they've really behaved, honestly, relative to the stupidity of myself at that age. But now so now the colleges will remain shut down. And again, the multiplier effect, if you want to see a multiplier effect, the multiplier effect from all these small businesses not reopening is significant. The multiplier effect from not having college football games is enormous. Think about it. I have several friends who are manufacturers reps, and these are very old, they're friends of mine from grammar school and high school, who are manufacturers reps, children's back to school. There is no back to school. And my dear friend Max sells children's uniforms for a company. I was talking to him, played golf with him yesterday, and we were talking, but we talk all the time because I'm kind of feeling my way with him. There's nothing. You're not going back to school. You're not buying school uniforms. And those are, as many of the big stores, he sells to a lot of small stores, especially in inner city neighborhoods, because there are a lot of those kids who have to wear school uniforms because they wanted to get all the gang colors out. So that's a big business for him. There is none. My other friend Scotty who reps all kinds of athletic wear and active wear. Nothing. Well, the active wear part, that's not true. But the other part with all the college logos and everything, that stuff's not selling whatsoever. So there's a lot of this is all anecdotal, of course. There's a lot of multiplier effects that aren't getting lifted here. And I guess we're going to, just as we thought and we talked about last week and this week and the week before that, there'll be a compromise here because I think the Democrats have realized they're not looking good by defending the big cities and allowing the Republicans to stonewall and slow this down. And they look, and the reason that they want to say that they're doing it, forget the post office, of course, they're helping Main Street. And that's not a good position for the Democrats to be in. So they're going to reach some kind of compromise here without the cities getting the kind of money that the Democrats are hoping to get. And we'll probably see a total package. I'd say we'll make it to $2 trillion on the package, which I thought we would have gotten to originally, that the Democrats reaching for $3.5 trillion in total, way too much. So they'll hit some number but it still doesn't take the Fed off the hook. But when I reread those minutes, maybe they're a little bit more nervous than they've led on to in the past about, this is maybe a little too much, too fast, and they're actually listening to some of the markets, although the equity markets are the equity markets, and Trump is in it.
Ira, to your point, one of my tenants came in late with the rent and came in my office to talk to me. I have a few tenants.
Yeah.
And I'm friends with my tenants, and they're also, the other half, how do they live, And he told me he had just lost his job. It's a local contractor, mostly doing defense work. And he said the PPP money's all gone and the company's shutting down. So he's lost his job until further notice. So it's kind of an example of what you're talking about too.
Well, my son-in-law down in Florida, he staffs golf courses with workers, and they do some other light stuff, but nothing heavy because they don't want the workman's comp liabilities that you get in heavier projects. So they don't staff that. But he was telling me they can't he had to drive to Tampa yesterday because one of the firms that they supply people for, they couldn't get workers. The workers all walked off because they're getting more. He says, I'm not telling you anything, but it's a problem because they're making more from the checks that they received than they'd be getting paid. Now, my sense is, well, shame on you. Everybody should be paying them more. That's what I said, well, ramp up their pay. Give them a bonus, upfront bonus. But the firms don't want to pay it because once they start down that path, they don't know where it's going to stop. And I said, Josh, and it was true that his firm gave them breaks at the beginning during the March and April point of the pandemic, which was very severe. They worked with their people, those who couldn't make their payments. They covered the wages. They got paid. I said that'll build a lot of goodwill. But now it's going the other way. I said, hey, they need the workers. They got to pay up. So I don't know where he was driving to troubleshoot the situation, but that is a problem. That is a problem.
Well, the market, I think by the end of the week, will know your sentiments with respect to those minutes. Was it Powell's intention to walk back a little bit of the activity in the market at the moment? As was saying before, that they'll ultimately end up being at your control, but at what point and what price?
Well, yeah, and again, so much is depend. I mean, this is the Fed, and let's think about who came out over the weekend. Buffett. So now he looks, gotten slapped. Is usually when it comes to global macro stuff. Again, he's not my go-to guy, and that was a total global macro speech. Now, Andrew, I'm glad that you're here because one of the things we wanted to talk about when you weren't around was how high, and we talked about it on Monday, I think, Judd, on the Aussie Kiwi, how high it got.
Yeah, we looked at that a few minutes ago too. Here, let me put it back up.
Yeah, so we got when we were talking the other day, it was up at 110.40, and we said that's high. That's going to bother the Aussies. There's no question. Was I right in speaking about that?
Yeah,
you were, and we were discussing it before you came back on. And I mean, obviously, if you look at the Aussie Kiwi since Angello was asking about it, and by and large, since 2014, it's traded between 110 and 1. But there are some good trades within the Kiwi when you start hearing what we were discussing on what you discussed on Monday regarding negative rates. I think the action of the Aussie Kiwi not following through might be also a sign that the board is telling us that we're going to see some risk off. Now, that's the perverse way of sort of looking at it, but I go to Kiwi yen to think about, okay, if the Kiwis are going to get aggressive, which I think they will, because they're going to have to, because effectively they've shut their freaking country down from the world for the foreseeable future, and they're not going to be able to tolerate a higher Kiwi. So they will. I think they will have to sacrifice some of the banking financial system, or at least by taking themselves aggressively into the negative. ANZ called out yesterday they'll go 50 basis points negative, not 25. So I'm looking at Kiwi now against the yen. But from the seasonality perspective, it's perfectly low for another 4 weeks. But more so, I think the way the board played out today, that trade could be a good trade to play the negative rate Kiwi.
Well, you mean long yen and short Kiwi?
Correct. Yeah.
Andrew?
Yes, correct.
Okay.
I had that trade. I put that trade on today around 75.
Yeah.
I got 50 points through, and if the board, I'll be looking for some action in Asia today. Typically, when the one thing I watch in Asia is the Simex Nikkei NH1 is the Bloomberg code. I'm not sure what is CQG, because the contract trades 8 a.m. till 7 p.m. So it trades like a new market, and it does, as opposed to the Topix, which is a Tokyo Stock Exchange, which just picks up the previous night's action. If I start seeing some weakness in that today, in the Nikkei, particularly leading the market, then I think it's sniffing out a stronger yen again.
Okay.
And I will, and if obviously the other things on the board start playing out, like lower gold or even the bonds continue to sell off, then I think they're constantly on. Now, I think you were right to lead out with the Kiwi this morning on Monday, because if negative rates is where they're going, which I think they will, because the RBNZ flags the market, as you know, then I think Kiwi yen could be the way to play it.
Well, as I wrote to Judd this morning, right out of the chute, I said I was shorting the euro yen.
Great spot.
Yeah, well, I mean, I was just testing the waters a little bit because, I'm not a big believer in the commitment of traders report for many times that I've written about. And everybody's out there talking about how long hedge funds are and everybody. But we know that when currencies start to get momentum, they can push a long way regardless. Thank you, Penn.
I agree with that.
But one of the things
it's only captures the futures market. I mean, God, the physical market.
Exactly.
Off the charts. I mean, I've seen when Aussie's gone from 85 to 55, it's been short for 15%.
You know what, Andrew? That's exactly what I talk about, because when I used to have to file them, when I was a currency arbitrager, and I had to fill them out, because if you had a position of more than 25 contracts, you were required. I lied through my teeth because it was all, well, why, you know what? They were exactly why Andrew says they meant nothing anyway, because the CFTC used to put out the report, but so if I was long at the CME, my longs were nothing because I had a short at the bank. I had to be 100% hedged or I was in violation of my covenants. So that was a meaningless situation. And that's what I still see, because now you have all kinds of players. You have people playing the FXE. You have people all over the place. So you're only seeing one side of the position.
Absolutely. I mean, it does work in a range chart. It's not dissimilar to an RSI.
Right.
It works.
Right. I know.
Picks up the shorter term flow. I mean, look, it's a relatively interesting indicator, but currency market over the counter is the biggest market in the world.
Yeah, right. And there's so many different permutations going on at any, they're doing these and then one day we were talking about knockout options.
Yeah.
I don't know how much they still take place in the market. I know for about 5-6 years they were.
Where they take place now? They used
Ladbrokes.
Sorry.
At the gambling houses in London, the betting shops.
Well, it's no, actually, sadly, worse than that.
Yeah.
The knockouts and knock-ins and all the exotic crap, which was just written for option desks, not for the actual risk to the owner. So all these major Western Unions and in Australia OFX, and I don't know who the big remitters are in the States, who look after SMEs and corporates. So they've moved those wonderful underlying those hedges to the SME and SME micro segment corporates who have actually underlying exposures to these currencies movements. So and they sell all this crap, toxic crap to them, take huge margin out of them, and in the end, when markets get volatile, they lose their hedge because they get knocked out.
Right.
So it's that Aussie move from 60 to 54. If you remember earlier this year, it's moved within 2 hours.
Right.
That was all. It was all the Aussie. All the people who had Aussie exposure and need a left-hand side hedging, bought their puts at 70 cents, but were sold them at zero cost with a huge margin to the Western Unions of the world, but they get knocked out at 60 cents. They hit 60 cents, their hedge they had at 70 is completely gone, and their underlying business selling widgets has gone bankrupt. That's what's happening.
Yeah, I know they're making. I know there's so much stuff going on, but you know, with the minutes, they were not as dovish as the press conference, and I think that's the real takeaway for me. Only because they left the yield curve like they did not want to go down that road, so the market is interpreting that as more hawkish. I don't know how you can define hawkish is a very relative term here. My sense is we'll see. Right now, the gold has broken $40 basically since the pit close, as we would say. The silver is down $1. These are significant moves, but they're setting Asia up for a sell-off as far as I'm concerned. So how Asia closes tonight will be very important for me to see whether they take the bait to continue the sell-off or whether they reverse. If they reverse it, that'll be very interesting to me. If not, just more of the correction, which is fine. Markets are supposed to correct. I have no problem with the pain trade, as we say.
I'm looking at the 210s, Ira. That's an interesting move today. I haven't even looked at the curves.
Yeah, I mean, it's really not. Let's see, where did I come in this morning? Let me go.
I mean, the pattern looks like they want to keep going, but we'll see.
Let me see where we started this morning.
210s, the 25s have potential too.
Let's see. Where the fuck are you? Let's see. Where am I at?
Yeah, and the 510s, the whole,
Oh, hold on. So much shit to read.
yeah, and the 1030 too. I mean, that's all of them look like they can do more technically, anyways, from the setup.
Yeah, wait, hold on. Let's see. Oh, shoot. I gotta find this. Yes, I mean, that's the reaction. And I think that's what the market is drawing itself out of, is that. And it's, makes perfect sense to me. Because they had set up, they were looking for something much more aggressive on yield curve control. And I'm in the camp that if you go to yield curve control, it'll be a very dovish. Let's see. I'm just trying to figure out, I just want to go back and look to see when I came in this morning where that 210 was. See if I have it listed here. Or would I have lost it? No. Okay. For some reason, I no longer have it. Angry, I always save that. The fact that they weren't in an aggressive mood, and it's like they're very tentative about wanting to do it. I think that's what I would say the takeaway of this is. They are very tentative about yield curve control. Now, that doesn't mean that they don't have other plans that may be very market moving. But right now, the market wanted to see what it was about yield curve control, and they really seem reticent. And that's the best word I can put to it, reticent to go down that path. And I think that's why we're seeing the type of action that we've been seeing since that. Now, it is interesting. I don't know this factually. I'm going to have to, and if somebody knows, pipe up. Okay, here, I found what I wanted. Okay, so when I came in this morning, the US 210 was 52.4. It's probably, I'm going to gather, around 54 right now, which is a little towards the high side. But again, we see the market doing this, right? We saw this last week. Remember when we had the inflation data and the long end of the curve, those yields jumped higher and we saw some steepeners. And what happened? The metals sold off hard. That was the Tuesday, Wednesday sell-off.
Right.
We were waiting to see what happened that day because at first the dollar was weak, but the dollar did rally as the metals sold off. So we saw that correction. We saw a pretty sizable correction in the euro. In fact, let's go to that Monday. I think it was Tuesday, Wednesday, Judd. So let's look at that. Yeah, see, we get the correction on, what's the date today? The 19th, right? So, yep, started that correction. The market was, the euro was higher on that Tuesday. And boom, when the metals broke, we got a pretty good sell-off in the euro. We got a 100-point sell-off in the euro. And then
I was mentioning to Judd before that not forgetting that the high price of 1999 still sits at 119.10. So we've got, until we get some good closing action above there, I'm still wary of the level.
Yeah, and that's it. That's a good point. But you know what? I just wanted to add, well, so why, when I talked to Judd this morning on the euro yen, why I was selling the euro yen is because I'm still bearish the dollar. But I thought the euro might have a little problem because of Belarus and Turkey. Because Turkey is.
Can you say that again?
Because of Belarus and Turkey.
Right.
Hold on one second. Hold on. You need this? Yeah, okay. All right. Well, I'm going to go ahead and carry on. I'm going to put you on. I'm going to mute myself for a minute because I'm doing something with putting a house on the market. So hold on one second. Let me just mute myself so they can.
Judd, I sent you the chart that you may want to share of the S&P Nasdaq overlay to the US 10-year yield.
Did you send it the other day, or did you just send it?
Just sent it.
There it is, right there. Okay.
So that implies that if the yields do continue to kick, then you're going to get some, that ratio should help work in favor of the S&P over the Nasdaq, but it still, I would argue, puts a lot of pressure on the Nasdaq and some of those frothy names.
Hold on, I'm going to pull this up. There it is. So that's the SPX, and that's 10-year yield. And then we
pretty much the same trade, but as we saw a few weeks ago, that key reversal. If that key reversal even works for a few months, and the Nasdaq's got a few problems ahead of it.
Yeah, and then when you go to where am I here? Here, we'll just put.
Right, I'm back.
Okay, oh, hold on. There, here, let me pull this over for you. You see this SPX, and that's a 10-year yield, Ira?
Hold on. Okay, yes, I see it.
Okay. So we were looking at that, and then
I was just saying, in terms of this, a few weeks ago, there was a big key reversal on the S&P against the Nasdaq, and it was actually ironically matching the low of the year 2000. So I was fascinated by that. Now, that chart I sent through to Judd, Bloomberg ratio of the S&P Nasdaq with the 10-year yield overlaying, which makes sense. If the yields kick higher, it's going to put more pressure on the Nasdaq than it is the S&P, and that's sort of another market I'm watching. But you were saying the Belarus-Turkey thing.
Yeah, you know what? It's because it's a much more European thing, especially because Macron stuck his nose in there. But that's not unusual because the problems with the Turks in Europe have been great. because Erdogan is a difficult. I think he is the true autocrat. You look at some of the things that he's done, and people seem to look past it. But there was very bad blood between Sarkozy and Erdogan going back to 2012, when Turkey was supposed to be pushed forward for full membership into the EU, and Sarkozy wasn't having it. So the feelings have been a little frayed, to say the least. And now the Turks are pushing, I don't know if people are aware of this, they're pushing hard on trying to exploit some of the natural gas drilling in the Eastern Mediterranean, where Israel and Cyprus and the Greeks and somebody else has hit, well, the Israelis have hit the Leviathan field, what they call the Leviathan. That's a huge find, which they sell a lot of natural gas now to Egypt and to Jordan. But Cyprus, and they've worked out some agreements, and the Turks are now getting bellicose by sending in naval ships saying that these are their, that they have rights to this. And then the French stuck their nose in last week or 2 weeks ago and said, no. So don't forget, this is now a NATO issue. And it's a NATO issue and it's an EU issue. So, and you know how bullish I've been the euro, but that's why if this is really a dollar move, I thought the yen would kind of take over. So that's what I was playing with this morning, Judd, when I texted you about that, because I see the rhetoric ramping up, and of course the Belarus situation with the Russians heavily involved.
Well, the lira actually strengthened on that.
Yeah, but some of that could be central bank intervention. The Turk central bank is a very active central bank, so we don't know that. We'll have to see how some of that plays out, but it is something that you have to watch here, and it's a NATO issue, but it's not predominantly a U.S. issue at this time, because Macron has put in more than his 2 cents on this, and Erdogan responded directly to him. So it's another thing. And I said, if the dollar can go down here, I don't know that the euro will lead. And the way the yen, even last night, and it's not like the data has been extraordinarily good, but I think the yen has benefited from what Andrew and I talked about a few weeks ago, which is, the place with the highest real yields is Japan.
Yeah.
Right? The highest. Australia, no, negative real yields. The key, they told us how far they'll go, and that won't sit comfortably with Governor Lowe nor anybody else in Australia, especially because you saw that cross up at 110.40, which was a fairly elevated level for these times. The UK, negative real yields. Europe, negative real yields. The US, certainly negative real yields. Japan, probably on a real yield basis, which is what Buffett was speaking to in my interpretation of what he had to say over the weekend. So I want to see, now the yen got beat up pretty good today too. Late, it was trying to hold on at that really, to me, a critical level at that 105. Between 65 and 85, it was trying to hold it, couldn't do it, especially late after the release of the FOMC minutes. It was trying to hold in there too, and then got a good kick in the head.
I'm just looking at where it's at on the cloud crosses and everything and the pattern, and that's going to be a real hard area to follow through if it continues to weaken. And it's at a matrix level. It's at all sorts of stuff there. And the other one that's matching up with that, Ira, is the Aussie.
Yep.
So
your matrix level nailed the Aussie this week, Judd. 72.76.
Yeah, there it is. And it just nailed it again down here because you got another level to today, and
Sorry,
it's
77. Yeah, go on.
yeah, and it's right into that same kind of congestion level on the cloud as the Kiwi or the yen is. So the one that looks like it can go is the pound.
Well, I mean, it's interesting on the Kiwi, Aussie Kiwi. I mean, that was pretty aggressive stuff, and the major banks in ANZ and Westpac both have now called for 50 basis points negative, and the Kiwi is now stronger than the Aussie was on Monday.
Yeah.
So that tells me that maybe this has got more to do with the risk off, risk on board than it has to do with the relationship between the two currencies.
Yeah, maybe with the Kiwi, the RBNZ was trying to get away with a good one, weren't they?
Absolutely.
I thought that was, come on, as you would say, come on, mates, that we're not buying any of that. It's enough for them to ramp up QE from 95 to 100. But the other talk about possibly negative rates, and I saw somebody made a comment about the Kiwi would go to negative rates by April of 2021. And I go, why would anybody even publish this? That is such a ridiculous statement. 2021, you don't know what October 2020 looks like.
Yeah.
So
yeah.
But I know that cross up there, we had talked about it that was a problem for a lot of different reasons. And
yeah.
again, if they don't get this package out, I'm hearing from people about the serious nature of what's coming down the pike here, about how many people are really going to be in default and arrears under rents and I'm not, and that's besides I get to the commercial people. So there's a lot of stuff here. And again, just because, so it showed me that the market was really anticipating some type of yield curve control as being the supreme dovish policy tool. And now that they're not seeing that, so that's why I say the FOMC minutes were not nearly as dovish as Powell's press conference.
Yeah.
Well,
But again, it just needs yields to kick up. It doesn't need to kick up a lot, but it can kick up a little, considering where the pricing was going into this, to have an impact. I think at least. And I mean, look, some of these setups going into Thursday, Friday. If we use some of these reversals on the weekends, are very bad.
Yeah.
I don't think we've got the secular backdrop yet that says yield curve control is necessary.
Angelo, I couldn't agree with you more, and that's how I would sum up these minutes.
Yeah, I mean, we're not there yet. That's why I was saying to myself, yeah, they don't want to come out with it now because they know they don't need it right now. But when the setup is there, I think it's going to be a totally different conversation.
Oh, yeah. Oh.
Once, unemployment gets back to some reasonable levels, we're getting organic growth, which we're not getting that right now. So I'm just guessing here, but that's, organic growth and a recovery in the labor cycle. I don't know, this time next year, next summer maybe.
You know what? Again, I raised a question in December. If we're at 9% and 6%, 9% real unemployment and 6% annualized inflation, tell me what the policy is. And if the policy hasn't changed, now that may mean that we don't get yield curve control. Okay, that removes, in Japanese parlance, it removes one of the arrows from the quiver. If we go back to Abe's 3 arrows, it will remove one of the arrows from the quiver, but Fed policy is still phenomenally aggressive on doing liquidity hedges.
Yeah. Well,
they're not-
I think there's a couple of things that I think we need to see how they play out first, and it's the reestablishment of payments, or the rolling off. Let's call it the rolling off of all of the forbearance programs,
Yep.
and the phasing out of stimulus. You know, does that give us a hit to consumption? Which is that's my belief, is that we'll see a hit to consumption. You know, so I definitely get where you're coming from. You know, with the 9% unemployment and inflation rising. You know, that I think that's going to be the setup, Ira. Right?
Well,
But-
I agree with Angelo. I agree. And if you read the minutes, see the part where they did sustain the dovishness was the concern was still on disinflation or deflation. They thought that that was still the larger threat, but they didn't want to walk right into yield curve control. So what they're most afraid of, and that's, you know, my contention about the metals, why they are, it's not an inflation play, it's the fear of deflation. And that rang true throughout these minutes. But the market is totally focused on, well, yield curve control seems to be off the table for now, and that's hawkish. But you're 100% right. That's how the market is setting up, exactly the way you lay it out.
You know, where did the bonds correct to?
No,
Somewhere important? Not in my book.
no, I don't. I got zero. I'm not even going to look at the damn matrix sheet, but I'll look at something else.
I mean, I'm looking at the lumber because I think that the lumber's almost doubled, and I think it's got a $9 target off the swings. And I think when that thing blows up, a lot of things are going to blow up.
You know what? Yeah, but they keep coming up with the housing. You know, the housing that's truly, to me, if I can say so, a tale of two cities. You are getting now these large builders, Toll Brothers. Let's go down the list of them. And I see it in Arizona where they're very active and land is cheap. You know, the land that we occupy from the Apaches. And the Comancheros. So all that land cheap. And they're building because there's a huge influx from California, by the way. And you're seeing it here. And I'll let you know, 'cause I'm right on the border of Chicago, literally on the border, but I'm in a suburb, in a small suburb. I'll see how much activity I get as the house goes on the market today, or, you know, officially today or tomorrow in the listings. So I'll see, but stuff is actually selling here, and they're getting offer prices. People are looking to leave the city. So I think you're seeing builders kind of licking their chops in building outside the city for the first time in a long time. But somebody's going to be stuck with a boatload of property in the city, a boatload of apartments and condominiums. And I'm hearing it in New York. I'm hearing
Big
it
time.
about big time. Big time.
New York City and San Francisco are getting clobbered right now. And that's the two big exoduses are from those two cities. And interestingly, the two top cities that New Yorkers are going to is Atlanta and Nashville.
You know, Nashville's huge, but they're also seeing, and my buddy Johnny, who's the best gold. I should get him to call in. He's great. He's been doing gold mining analysis since the late 70s. I mean, he is really good, and he lives in Woodstock, New York.
Oh yeah. The Catskills, Ira.
Yeah,
Home sales up in the Catskills are up over 20%.
He is so pissed. He is so pissed. He said, I went here to escape everybody and just live my life in some quiet sense and, you know, deal with the artists and enjoy life. And now he says, my property is rising dramatically and I hate it. I just want to be left alone. So we go back and forth on email all day long. He is really a great gold stock analyst. He's the best one I know. He's been doing it for a very, very long time. Very long time for my, but he hates it because he says nothing stays on it for more than a day or two. And people are buying stuff sight unseen. They're online.
Yeah, everybody wants out.
They want to, and this is, they just want out.
Same here, Ira.
Huh?
Same where I live at Bucks County, PA. Same.
Oh, yeah, you know what? That's right. I know. I just.
Same in Sydney as well. I mean, everyone's, I guess thinking that through, one of the biggest banks in the world reported their numbers. Interesting is in Australia, because effectively Australia's an oligopoly still in banking, and Commonwealth Bank. And they came last week, they cut their dividend to zero, and they own pretty much, 60% of the Australian housing market and commercial real estate. And that's all that stuff's going to end up in the banks got a huge amount of pain ahead.
Well, again, the one bank that I've watched for a long time as a weather vane is NYCB, New York Community Bank, which I liked at one time, but once I got a little nervous, and I'm going back 4 years already, the New York real estate market, they were too overextended. So it's one of my ones that I'm watching. It's actually holding up better than I thought in this, but it's something I really keep on my radar screen. Penn may know about more of it. Let's see. I haven't put up a chart in a while.
I got it up right now.
Yeah, I mean, you
Just
can
a
see.
big sideways pattern. Down.
Yeah, and if you look at it on a weekly, you'll see how it broke down.
Yeah.
I think we started watching it, Judd, in 2015, 16. And it's really been, and they did a buy, they took over another bank, Dollar, I don't know, one of the, Astoria Bank. I think they bought Astoria. And that's, from that point on, it has not been a solid play at all.
Sales of homes priced at $2 million and up in the tri-state area are up. Sales are up over 200%.
I know in Westchester County it's gone nuts.
Yeah, Fairfield, Westchester, Bergen.
Yeah. Pete, where are you at in Bucks County? Was that Pete before?
Yeah, that was. He is in Bucks County.
Yeah.
Yeah. You know what? I never really realized how close Scranton was to New York City, and you could actually commute.
No, I don't know about that.
What's that?
Well, you know what, Judd? Who was that?
Ira, you cannot commute from Scranton to New York.
Wait, hold on. I know somebody. Remember that guy? He was a great technician on the floor. He was a wacky guy, but I loved him. He was really a character. And then he went to work as Morgan Stanley's in-house technician.
It wasn't Lev. It was
No.
it was the guy that wore the black satin cape and rollerbladed down LaSalle Street every morning?
No, that was that other whack job. No, this guy was a really nice guy. He was short with like sandy blondish hair, but he was really a good technician. I think he may have learned from Howie too. And then he was the in-house technician. He had a big job at Morgan Stanley. And when I went to Morgan Stanley once, one of the times to talk to the guy who headed up their commodity division, Neil Scherer, brilliant guy. And there was Andrew. His name was Andrew. They called him Drew. Can't remember his last name. But he lived in Scranton and commuted. He'd leave for work at 4 a.m. every day.
Yeah, I mean, Jeff just put it in. There's so many rich folks coming in Aspen, they can't even park their tubes. They have to it's drop off only.
You know what?
Judd, remember 2 years ago when you said everyone was trying to sell?
Yeah.
But guys,
Revert.
this is Robert. It's not only those places. I live in Wichita, Kansas, and that literally over the last 2 weeks, the prices went up 16%. We live in a relatively young subdivision. They're still building in it. And the leaflets on the front of the house are literally scratched, and the new price by the builder just jumps $15,000, $16,000. I cannot believe it. It's the Midwest.
Yeah, but that's because of the barbecue. They closed those barbecue shacks. Nobody would live there. No, there are many things going on. The housing market, it's the tale of two cities because, again, there's all. I look it down in Chicago and all this stuff. I mean, there are so many buildings that have come online in the last 3-4 years. I just have to wonder.
You got to be nuts going down there. There was a woman on the news the other day screaming at Lightfoot. I pay $17,500 in taxes down here, and I'm afraid to walk out the door.
Yeah, no, I hear that.
And they're right. They're afraid to walk out the door because it's unsafe.
I hear that from people, and usually, but these are people who all ran to the city from the suburbs, to take part in the life that Penn lives every day and enjoy, being able to walk to everything. But, instead of getting your car, because if there's one thing about Chicago I hate, is that it's an automobile city, where New York is not an automobile city.
Yeah, well, Arco lives down there. I don't know how much he's enjoying it.
Who does?
Gary Cost.
I haven't seen him in ages. No kidding. I didn't know that.
Yeah, he's in the room all the time. I don't think he's in right now, but he moved right over there on the. He's in.
Yeah.
He lives right downtown across from Northwestern.
Yeah.
Ira, the other thing that's coming up in September, in addition to the ongoing stimulus negotiations, is going to be the federal budget negotiations.
Oh yeah, yeah. Oh yeah, those two.
So there's a whole bunch of things that are going to intersect in the next couple of months. That depending on how much they end up spending, could be a reflection of the currencies and the dollar again. So, but this correction here, I think, was overdue. But I'm with you. I think it was triggered by the yield curve comments.
Again, right. And we saw it last week, so now it plays out again. But again, I'll be more interested to see where we close on Friday. Much more interested.
Well, and we have options expiration on Friday.
Oh, yeah.
But I think a lot of these guys, I think these guys kind of did whatever they were going to do today. That's why some whipsaw.
Yeah, you know what? From the foreign currency business, what was interesting is how weak the yen started out this morning and overnight. So, I have to believe the S&B was in. They just did not like the level. We don't know. We'll only find out, of course, 30 days after the fact. But that because the Swiss was awfully weak this morning, long before the gold fell apart.
I don't know what the answer is. It could be argued, for instance, that being lawfully here is enough to
just things that you have to pay attention to. Know that they're not per se, but they give you the global macro picture. And maybe tomorrow, Friday, Andrew and I will pick up on some more of this. But I'm going to set it up. That's the way I make the minutes. He asked me the fact definitive to say we're, if we see this, they're still talking about, of course, the impact of a possible vaccine. But we're slipping, and when do we lose the Christmas season?
Oh, good point. But the Christmas season's all Target and Amazon.
Well, you know, and it is interesting.
What is that crazy?
Target did, because there is the back to school clothes, you know, which is huge. It's a huge part of the market. It's just not there.
Yes, it's not something.
It's not there, and there's no end in sight to this, by the way.
Yeah, well, a lot of those stores too are the ones that either deliver or they will, you know, you can order like Best Buy and Target and they'll drop it in your trunk when you show up. And all these stores that refuse to come out and deliver to you,
Yep.
I don't go there anymore.
Well, yeah, but Judd, I'm talking about the huge impact of back to school.
Yeah.
It's huge. It's huge.
Maybe he's all wet. I know.
It's a lot of money.
It's huge.
I think he's a great guy, smart lawyer. He's an expert. But whenever you hear the media say the experts say it's wrong, that's not true.
All right, I'm going to kick off. Thanks.
Thanks, Ira, for coming in and joining us.
All right, we'll see. And we'll pay attention tomorrow. Maybe tomorrow, Andrew, do some homework on the FOMC and we'll continue. Because I think that has a bigger short-term impact. And it really reflects what we saw last week. So we'll watch those curves and everything that dances around it.
I agree. I think the closes this week could be the setup for the next 6 weeks. So.
Well, let's look at something, though, okay? I'm going to put up the 204. I just want to see what the low was last week. See, we didn't make a new low in the 30 years from when the last when we did that. No,
and it's you know it's just in a funky spot. I mean, last week's low in the 30 was 177.16.
Yeah,
but the currencies could do some horrible weekly reversals if these things keep up.
I'm sorry, I didn't hear. I couldn't.
The currencies could do some massive reversals if this week keeps up. I mean, they've got a lot more work to do.
Yeah.
You close at 71.20 in the week, you're going to outside reverse the lower week.
Yep. So we'll watch the crosses closely to see if they give us any indication of that.
Yeah. All right. Well, thanks.
All right.
Chats.
Yep.
All right, guys.